March 13th, 2023. The worst single day in systematic hedge fund history. Schroeder Gaia Blue Trend lost 7.4%. Aspect Diversified fell 5.9%. Lynx UCITS dropped 6.9%. The paradox, while these AI funds underperformed the S&P 500 by 95 percentage points over a decade, institutional money poured in. Assets exploded from $200 billion to $1.2 trillion. This is not the future. This is managing your retirement right now. From January 2011 to January 2020, AI hedge funds returned 115% cumulatively. The S&P 500 gained 210%. That 95-point gap means $100,000 invested in the average AI fund made you $95,000 less than buying the index and forgetting about it. Several heavily funded AI hedge funds shut down after weak performance. Idea trading in Hong Kong closed. Sentient Technologies burned through $143 million in venture capital before shutting down. IBM Watson-powered funds underperformed their benchmarks and quietly disappeared. During this exact period of documented underperformance, AI hedge fund assets grew by 650%. Annual growth rate, 27%. By 2024, Two Sigma Delaware, Shaw, and Bridgewater collectively controlled over $200 billion using mostly systematic approaches. If you manage institutional money or just want to understand where your retirement fees actually go, subscribe. This series maps the mechanics that affect everyone's savings. Why did institutions keep investing? The pitch was not about beating markets. It was about uncorrelated returns. Carlos Rangel, chief investment officer of the $8 billion Kellogg Foundation, stated they maintain 20% hedge fund allocation because when markets go down, we still need cash flow for the communities we serve. This diversification mandate became the institutional defense. J.P. Morgan Asset Management emphasized that machine learning strategies aim to deliver persistent, uncorrelated alpha streams. Notice the conditional language. Strategies that aim. Returns that may offer potential. Alpha streams likely to be less correlated. Framing, not demonstrated results. An Ernst & Young survey in 2018 found over 40% of hedge fund investors considered it critically important that managers use AI in their investment processes. AI adoption itself became an institutional requirement independent of performance outcomes. Investment consultants provided crucial cover. Cambridge Associates managed $32 billion and was named Hedge Fund Consultant of the Year in 2019. Their methodology prioritized identifying managers with a clear edge through qualitative assessment rather than performance metrics. A CNBC investigation exposed the dynamic. Investment consultants do not disclose their track records, yet pension funds use them because it is backside covering. Easy to say you took expert advice. The fee structure sealed it. Harvard Law School research found that for every dollar of profit generated by hedge funds, 64 cents was retained as fees. On $5 trillion in assets, even with compressed fees averaging 1.4%, the industry collected $70 billion annually regardless of performance. When you collect $70 billion a year in management fees, your incentive is to maintain and grow assets under management, not necessarily optimize returns. This is not conspiracy, it is economics. Different AI strategies do not just succeed or fail. They succeed or fail in different market conditions. 2022 to 2023 created a perfect natural experiment. In 2022, systematic trend-following funds had their best year ever. The SocGen Trend Index delivered 27.3%. These algorithms detect and follow sustained directional moves. 2022 gave them exactly that. First year since 1977, when both stocks and bonds declined together. The Federal Reserve executed the fastest rate hiking cycle in modern history. Excellent trend quality with sustained directional moves. 2023 brought complete reversal. The same strategies that dominated suffered catastrophically. Quant CTA strategies lost 3.8%. March 2023 proved particularly brutal, with losses of 6 to 7% as the banking crisis created rapid trend reversals. Meanwhile, a completely different strategy excelled both years. Statistical arbitrage delivered 12.7% in 2022 and 10.9% in 2023. This strategy exploits temporary deviations from equilibrium relationships between assets. High volatility creates larger temporary mispricings. Choppy markets generate more opportunities. Trend following gained 27% in 2022, but lost 4% in 2023. Statistical arbitrage gained consistently both years. Neither strategy fundamentally changed. The algorithms were identical. The market regime changed. These are not general intelligence systems adapting to any condition. They are pattern recognition machines. Trend following fundamentally requires sustained trends. Statistical arbitrage fundamentally requires mean reversion. No algorithmic sophistication creates mean reversion where markets are trending. No algorithm profits from trends that reverse too quickly to capture. Stanford research on deep learning statistical arbitrage achieved annual Sharpe ratios exceeding 4.0 compared to 0.97 for traditional models. But both approaches failed in trending markets because the underlying mean reversion they assumed did not exist. This is why the performance paradox exists. AI hedge funds show you backtests proving their strategies work. Those backtests are accurate for the market regimes where the required properties existed. But when regimes flip, when fundamental market dynamics change, algorithms cannot adapt because they were not designed to recognize regime changes they have never seen before. Which brings us back to March 13, 2023. Systematic hedge funds suffered their worst losses in history. What makes this revealing is we can directly compare how AI systems and experienced human managers handled the exact same unprecedented event. March 8th, Silicon Valley Bank announced a $21 billion securities sale at $1.8 billion in losses. March 9th, bank run. $42 billion in withdrawal requests representing 25% of deposits. March 10th, SVB placed in FDIC receivership. The entire collapse occurred in 48 hours. This velocity was unprecedented. Traditional bank runs from the 90s and 2000s unfolded over weeks. SVB collapsed in 48 hours, amplified by Twitter and group chats, creating coordinated withdrawal behavior far faster than historical banking crises. AI systems trained on historical banking crises had no reference point for this velocity. Their training data showed regional banks as stable during 2009 to 2021, when interest rates were extraordinarily low. When 2023 brought rapid rate increases, creating unrealized losses on long-duration securities, the models had no framework to understand the changed dynamics. On March 13th, systematic trend-following funds suffered their worst-ever single-day losses. Bloomberg reported that market turmoil triggered by the collapse saw computer-driven hedge funds suffer their worst-ever day of losses on the back of big swings in bond markets. Contrast this with experienced human managers. Research by Alternative Soft found that managers who started before 2007, possessing pre-financial crisis experience, generated 5.23% annualized alpha in 2023. Bill Ackman's Pershing Square returned 26.7% net. Ken Griffin's Citadel returned 15.3%. What did experienced managers recognize that AI systems could not? They identified the classic pattern of unrealized losses, concentrated funding, and confidence evaporation. The same mechanics they had seen in 2008, just with Twitter as an accelerant. Pattern recognition across different domains. Bear Stearns had different specific characteristics than SVB, but the underlying dynamic of unrealized losses plus confidence loss plus liquidity crisis followed similar causal logic. The theoretical research explains why this happens. It is called the out-of-distribution generalization problem. Machine learning achieves tremendous success where training and testing distributions are similar. When models are tested on slightly different data than they were trained on, algorithms can fail spectacularly. The no-free lunch theorem, formalized by David Wolpert in 1996, proves this mathematically. Any two optimization algorithms are equivalent when performance is averaged across all possible problems. Superior performance on one class of problems is paid for in performance over another class. Algorithms can only outperform if they incorporate specific structural assumptions. When unprecedented events violate those assumptions, algorithms lose their advantage. This is not temporary. Better training data helps algorithms perform better on patterns similar to their training. But unprecedented events, by definition, lie outside the training distribution. The March 2023 banking crisis will now be in training data for future AI systems. But the next crisis will have different characteristics. Whatever specific features define the next unprecedented event will be novel in ways current training data cannot capture. I want to pause here because if you have money in a pension fund, if you have retirement savings managed by an institution, none of this is your fault. This is not about individual decisions. The allocators who kept investing in underperforming AI funds operated within consultant-mediated structures where AI exposure became an institutional requirement and fee systems rewarded asset gathering regardless of returns. When 40% of institutional investors consider AI adoption critically important regardless of performance, individual decision-makers are constrained by system logic. 3 specific signals to watch and 2 questions to ask. First signal, market regime identification. When markets show sustained trends with low reversal frequency, trend-following strategies perform well. When markets are choppy with frequent direction changes, statistical arbitrage excels. Track the VIX volatility index and market correlation patterns to identify which regime you are in. This tells you which types of strategies are likely facing headwinds. Second signal, watch for performance divergence between different quantitative strategies. If trend-following CTAs are suffering while statistical arbitrage funds are excelling, or vice versa, regime change is occurring. This is publicly reported monthly through indices like the SocGen CTA index. Divergence indicates the market environment favors specific mathematical properties over others. Third signal, pay attention to how funds performed during the most recent crisis. March 2023 is now in the historical record. Look up whether specific funds you are considering had exposure to systematic strategies that suffered worse day losses, or whether they had diversification that provided resilience. 2 questions to ask your financial advisor or institutional allocator. First question, what percentage of our portfolio is allocated to purely systematic AI-driven strategies versus strategies that combine algorithmic tools with human oversight? There is nothing wrong with systematic strategies, but concentration in purely algorithmic approaches creates fragility during unprecedented events. Second question, how do you evaluate manager performance over complete market cycles rather than individual years? If your advisor evaluates managers based on 1 or 2 years of returns, they are not capturing regime-dependent performance. The question is whether strategies provide value over complete cycles, including both trending and choppy regimes. The takeaway is not that AI hedge funds are bad or that algorithms do not work. The takeaway is that different strategies work in different conditions, that unprecedented events expose fundamental limitations in pattern recognition systems, and that diversification across both systematic and discretionary approaches provides resilience when market dynamics shift. The algorithms are already here. They are managing over $1 trillion. They will continue to be a major force in financial markets. But understanding their limitations, recognizing when market regimes favor or disfavor specific approaches, and maintaining exposure to experienced human judgment for tail events provides you with agency. Your retirement savings are increasingly managed by systems that excel in normal times but face mathematical constraints during the crises that matter most. Next video in this series examines which specific funds survived March 2023 and what strategies actually worked during the crisis. Subscribe to see how institutional money really moves when markets break.